Welcome to Tech Money Madness, your daily U.S. stock market podcast, May 2026.
Glad to be here.
If you're tuning in today, you're likely trying to cut through the relentless noise of the financial news cycle.
Oh, absolutely. There is a lot of noise out there right now.
Right. So our mission for this deep dive into today's sources is to give you a shortcut, a way to be well-informed without that crushing information overload. Because today, the market is basically pulling in two completely opposite directions.
Yeah, it really is a profound tug of war right now. I mean, the underlying mechanics of the market are fracturing into two highly distinct realities.
Massive tech growth on one side,
Yeah.
and then heavy macroeconomic headwinds on the other.
Exactly. Understanding how the digital economy and the physical economy are interacting, or, well, in some cases, outright ignoring each other, is crucial for anyone trying to navigate their portfolio this year.
So let's set the scene and look at the scoreboard. It's Friday, May 1st. And right now, the market is in a state of what analysts are calling cautious consolidation.
Cautious being the operative word there.
Right. The major indexes have spent the majority of the session just sort of, drifting sideways. But the baseline numbers they're drifting on are staggering. The S&P 500 advanced 0.7% to 7,262 today.
Which is a solid day on its own.
It is, but to put that into context, we really have to look at Thursday's record close of 7,209.01. That was a 1.02% gain that capped off just an explosive 10.4% run for the entire month of April.
Yeah, a 10.4% advance in a single month for the broader market is a historic anomaly. I mean, you normally hope for that kind of return over an entire calendar year, not 30 days.
Not 30 days exactly. It's the strongest monthly performance since November 2020. Meanwhile, the Nasdaq 100 just rose another 1.1% today, hitting 27,743.
Just relentless momentum.
Yeah. So looking at this drifting state today, it feels like a runner who just completed an all-out sprint, right? They completely crushed their personal best in April, and now they're standing at the bottom of the next hill, hands on their knees, catching their breath, and trying to decide exactly how to tackle the next severe incline.
What's fascinating here is how strong technology earnings are single-handedly driving the Nasdaq's ongoing rise, despite heavy challenges in almost every other sector.
Wait, single-handedly?
Pretty much, yeah. We have to look at the mechanics of market cap weighting. Because companies like Apple and Microsoft are so gigantic, their individual stock performance disproportionately moves the entire S&P 500.
Oh, I see.
Yeah, so you see that 10.4% April gain, and you might think, wow, the entire American economy is booming. But the reality is that a very specific, concentrated engine is pulling the rest of the train up the mountain.
Okay, let's unpack this. Let's transition from the broad market averages and look at the specific, massive engines driving those numbers, the tech titans, starting with the undisputed heavyweight, Apple.
Oh, yeah. Huge day for them.
Right. Apple's stock is seeing a colossal surge today, and it all comes down to their Q2 earnings report.
Oh, yeah.
But it's not the past quarter that has the street reacting. It's the forward-looking guidance.
Always is.
Yeah. Apple announced that their current quarter revenue growth is expected to hit somewhere between 14% and 17%.
Which completely obliterates Wall Street's estimates. I mean, for a company of Apple's size and maturity to project up to 17% growth in a single quarter is practically unheard of in a normal hardware cycle.
Right, because usually they're just too big to grow that fast.
Exactly. Usually at a multi-trillion-dollar scale, the law of large numbers kicks in, and growth slows to a steady crawl.
But wait, startup growth at that scale usually means profit margins suffer, right? Are they sacrificing their bottom line just to buy that 17% growth, or is something else happening here?
No, they're not sacrificing margins at all. It comes down to the fundamental mechanism of the AI supercycle.
Okay, how so?
Well, for the past few years, consumers were holding onto their smartphones for 4 or 5 years because the incremental updates, a slightly better camera, marginally faster screen, they just weren't worth the upgrade cost.
Yeah, guilty as charged. I held on to my last one forever.
Most people did. But now companies like Apple are leading this massive shift in AI innovation. They're embedding AI processing directly into the physical hardware. They're requiring entirely new internal architectures just to run the latest operating systems locally on the device.
Wow. So they aren't just selling software updates. They're forcing a physical hardware upgrade cycle because the old phones literally cannot compute the new AI features.
Precisely. By effectively monetizing this new technological paradigm, Apple creates a rising tide. They're effectively pulling the broader tech sector up with them. Suppliers, software developers, memory chip manufacturers, they all benefit.
It's an entire global supply chain leveling up at once. But Apple isn't the only giant making moves in this space today. We have to talk about Alphabet.
Alphabet is having a moment for sure.
They are on the verge of topping $5 trillion in market capitalization. $5 trillion. That is a number that's hard to even conceptualize. And with that valuation, they're threatening to overtake NVIDIA as the world's most valuable company.
The race for the top spot has never been more intense. We're watching a realignment of how the market values the different layers of the AI ecosystem.
Which makes me want to ask, is NVIDIA losing its grip, or is Alphabet just accelerating faster? Because for the last 2 years, NVIDIA has been the undisputed king of AI hardware.
It's much less about NVIDIA losing its technological edge and much more about the severe geopolitical friction they're suddenly encountering.
Friction like what?
Well, right now, NVIDIA is facing intense scrutiny from Washington. Senator Chris Coons is demanding concrete answers over NVIDIA's advanced chip sales to China.
Oh, right. So it's not a technology problem for NVIDIA, it's a national security problem.
Spot on. When you control the hardware that powers AI, you become an inevitable target for government regulation. AI innovation is an incredible tailwind, but geopolitical scrutiny is a powerful headwind.
And Alphabet doesn't have that same headwind.
Not to the same degree, no. Alphabet is primarily a software and services company, so they scale without physical borders. They're navigating this geopolitical stuff with much more agility than a hardware exporter like NVIDIA.
That dynamic between hardware infrastructure and software platforms brings us perfectly to the next layer of the market. Let's shift our focus to the software platforms actually deploying this tech to users.
The software sector is proving today that a rising tide does not lift all boats.
No, it definitely does not. Distinct user dynamics are causing wild swings in the stock market today. Let's look at Atlassian first. Their stock soared an incredible 29% today.
A massive win.
Huge. For anyone listening who has worked in a corporate office, you probably know Atlassian. They make essential enterprise tools. What is the actual catalyst behind a single-day jump like that?
The catalyst is phenomenal growth, specifically in their cloud and data center segments. As companies globally undergo digital transformations, they require robust, secure environments to manage their data. Atlassian is viewed as essential infrastructure, not optional software.
Now, let's contrast that enterprise win immediately with Roblox. While Atlassian is up 29%, Roblox shares plummeted 18% today.
A completely different narrative playing out on the exact same day.
And the reason is fascinating. The company reported that new child safety measures are heavily weighing on their bookings.
Yeah, that friction is hitting their bottom line hard.
To be clear, bookings in the gaming industry represent deferred revenue, right? It's the cash they collect today when users buy virtual currency, which is recognized as revenue later. And these safety measures are adding hurdles to that process.
If we connect this to the bigger picture, it explains how software companies are living and dying right now based on specific regulatory and demographic exposure, not just general tech enthusiasm.
Yeah, the way I visualize this divergence is Atlassian is essentially a company building corporate highways. They are thriving on endless infrastructure demand.
Great analogy.
Thanks. While Roblox is like a digital playground that suddenly got hit with incredibly strict, costly new zoning laws. The safety is necessary, but the financial reality is those guardrails limit the playground's profitability.
Exactly. It's the stark difference between B2B immunity and B2C vulnerability.
Which brings us to the forces completely outside of the tech bubble. Because these tech triumphs and stumbles aren't happening in a vacuum. They're colliding head-on with intense, real-world economic and political forces.
The physical world always reasserts itself.
It does. And just a quick, crucial note as we shift into these macro wins. To you, the listener, we are neutrally reporting the facts from today's market briefing.
Right, strictly looking at the number.
We are absolutely not taking any political sides or endorsing any viewpoints regarding these upcoming topics. We're just explaining how they move the money.
Understanding the mechanics of these macroeconomic wins is essential, regardless of your politics.
So let's look at geopolitics and energy. The ongoing Iran war is having a direct, heavy impact on global oil prices. But paradoxically, this volatility is specifically dragging down the energy sector.
Yeah, which confuses a lot of people. Because normally, high oil prices mean big profits for energy companies.
Exactly.
Yeah.
Why is the sector struggling when their product is getting more expensive?
Because the market is pricing in the fear of demand destruction. If oil prices spike rapidly due to conflict, it acts as a universal tax on the global consumer. People drive less, shipping costs explode. Investors fear the long-term economic slowdown that follows a geopolitical oil shock.
Makes total sense. And beyond the Middle East, we have sweeping trade moves. The Trump administration has made the decision to raise European Union auto tariffs to 25%
A 25% tariff is a seismic event for the global automotive industry.
because cars aren't just built in one place anymore.
Exactly. Parts cross borders multiple times before a vehicle is finished. A tariff of that magnitude compounds at every step, squeezing profit margins and forcing significant price increases for the consumer.
And when you combine compounding tariffs with volatile energy, you get inflation, which leads us to the organization tasked with fighting it. Here's where it gets really interesting. Drama at the Federal Reserve.
Oh, there's some serious drama unfolding there.
We have officials who specifically voted no on the recent post-meeting statement, coming out to explain their votes. They dissented specifically because they disagreed with hinting at an upcoming rate cut.
This is a crucial peek behind the institutional curtain. The Fed relies on presenting a united front to manage market psychology. When dissenting voters speak out, it tells Wall Street there is deep internal disagreement.
So the market can't confidently price in cheaper capital. And add to that, a secondary Fed drama today. Cost overruns are under investigation, and a U.S. attorney is expected to appeal a ruling that previously blocked this investigation.
Yeah, it adds institutional instability to the already heightened policy uncertainty. Fed uncertainty, trade wars, real wars, they all combine to create a ceiling for market enthusiasm outside of the tech sector.
It acts like gravity. Tech achieves escape velocity, but the rest of the market is firmly anchored by these macro headwinds.
Precisely.
So bringing all of this together, let's look at the scoreboard and extract the final themes for you. Quickly rattling off the day's biggest movers. Top gainers today were Apple, Atlassian, and Twilio.
All playing into that tech and enterprise strength.
Right. Top losers were Roblox, Amgen, and SMMT. And the most active stocks by sheer volume were Apple, Amazon, and Microsoft.
Capital is seeking safety in the trillion-dollar giants.
So what does this all mean? When we synthesize everything from AI hardware to Fed drama, what are the 5 main themes defining the market?
Well, first, geopolitical tensions are driving volatility, and we see that clearly in the energy sector struggle.
Demand destruction fears.
Right. Second, AI innovation continues to drive the historic tech boom, like we saw with Apple's hardware cycle.
Crushing those estimates.
Exactly. Third, we have a deeply polarized earnings season. Apple and Atlassian surge, while Roblox plummets.
Depending on demographic exposure.
You've got it. Fourth, Fed policy and interest rate uncertainty is looming over it all.
That ceiling we talked about.
Yep. And fifth, zooming out, we are witnessing massive sector shifts as technology fundamentally outpaces energy.
It truly is a market of extremes. You have $5 trillion milestones on one side and compounding tariffs and conflicts on the other.
Which leaves us with a fascinating question for the future.
Lay it on us.
If AI and big tech continue driving trillion-dollar valuations and breaking market records despite heavy macro headwinds like trade tariffs, global conflicts, and Fed uncertainty, are we witnessing a total decoupling of the technology sector from the physical economy?
Wow. Are they playing a completely different game with different rules? We will let you mull that one over. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.